Inflation, inflation, runaway inflation, runaway inflation. It seems to be the topic of the day when you look at financial markets. Everything seems to be aligning towards a bond rout, a US Treasury bond rout. And in fact, US Treasury yields have seemingly come unmoored, or have they? We're going to talk to Jeff Snider, the head of global research for Alhambra Partners. Jeff, pleasure to see you again. Welcome to the new year.
Yeah, Happy New Year to you, Emil.
I was just talking to the microphone, my setup here. The camera's down there. Okay, now I'm talking to you. All right, Jeff, we're on episode 41, and I've got it kicked off to a great start already. Episode 41. Episode 5 was the episode where we discussed modern myths like Kaiser Sose and bond kings. And bond kings is shorthand that you often raise, that U.S. Treasury yields have nowhere to go but up, that inflation is going to send that Treasury security up because what? Because of money printing from the federal government, from the central bank. And recently that seems to be maybe what's happening. It seems like there's an alignment of the planets that's where we're heading. So Jeff, let's discuss the article where you introduce us to what a real bond rout will look like.
Yeah, and I think, the shorthand for bond kings is that they're always saying interest rates have nowhere to go but up. It doesn't matter where we are or where anything is. That's always the message. And the lower interest rates go, the more forcefully they say they have nowhere to go but up, which, that makes kind of a bit of a sense, right? Eventually this thing has to turn around. And in the vernacular, they use the 30 or 40 year Treasury market or Treasury bull market must end at some point. And that's true. But what is it that drives Treasury yields? As you pointed out, Emil, inflation is one component of it. But really, it's inflation as the corroboration that the real economy underlying everything is behaving the way we want it to. We don't want consumer prices to go up because consumer prices to go up. What we want is to see that to check our assumptions. We say, okay, corporations have purchasing power because things are going well. They can raise prices, which tells us across a broad swath of the economy, things are going in the right direction. There's opportunity in real economic projects. And when that situation arises, who the hell wants to own safe instruments, especially safe instruments that are yielding you 1% or less? You don't want those things. So the underlying thesis of the bond kings, the interest rates have nowhere to go but up, is a sound one, except for the one caveat. The one caveat is the real economy, the big one, the big cheese. Is it really changed? And that's really what you need to ask yourself. If we're going to get into a bond rout situation, has something meaningfully changed in the economy? And what we come back with time and again is, well, no, but a government has done something new, or a central bank has done something new, not understanding that central banks and government are responding to the same thing that the bond market is pricing in terms of low interest rates. So those two things are always together. It's not the size of the stimulus. It's not the central bank coming up with a new form of QE that's going to do it. What changes us and gets us out of this quote-unquote bull market is when the real economy itself finally climbs out of its rut and says, yes, we're going to start growing again. We're going to start doing things like they used to be done. That's when you'll see a real bond rout. But there are times, because markets don't go in a straight line, there are short-term periods where it looks like, okay, maybe this is it. Maybe we'll give the government the benefit of the doubt. And as I wrote in the article that you're highlighting here, Emil, there was a big bond rout in 1998 and 1999 in Japan. If you go back and review the situation, it sounds so eerily familiar to today. It seems like everything lines up exactly in that way.
That's right. I'm glad you raised that entire point. It's not, and it's a topic we've discussed previously. When we're in a normal economic situation, not a depression, let's say, then maybe the federal government or the central government for our friends in Europe or Japan, if they do something, if they stimulate the economy, or if the central bank does something, then we'll rebound. And I'm referring to the plucking model of Milton Friedman. But we're not in a normal situation. We need more than just a one-time passing stimulus. So, Jeff, you bring up a depression that's already been in place since the 90s, and that's Japan. And you mentioned the 1997, 1998 time period. And give us a little bit of context around what was happening at that time. But Jeff, to be frank with you, even though your name is Jeff, and it's not fair to be frank to you, I looked at that graph. I didn't even see it because I pulled the data on a monthly basis. And I didn't even see the bound drought, so I'm spoiling it. It's not really in the bigger picture. It's not really a huge bond drought. But, I thought at first that you had made a mistake, and I thought you were referring to 87 to 88. That's a bond drought. But go ahead, tell us.
Yeah, no, you're
90s.
Exactly right. And that's, but at the time it seemed like this massive thing. And of course, given the context of where we are today, what happened in 97 or 98 and 99 was, it's epic compared to what's going on now because, okay, interest rates, JGB, Japan, yields on Japanese government bonds had been falling throughout the 90s. And the reason was because, as we said, the Japanese economy failed to recover time and again. There was the big bubble collapse, massive recession earlier in the decade. And then suddenly, wait a minute, no matter what the Japanese government did, no matter what the Bank of Japan did, growth was not coming back. And so as this situation changed from one of Japan Inc. being the envy of all the world to what the hell's going on in Japan, it can't even seem to recover, bond yields fall because you want to own safe and liquid instruments during periods of high economic uncertainty, financial uncertainty too. As we moved into 1997, what became known as the Asian flu or the Asian financial crisis, you have this, of course, financial monetary element to go along with Japan's depression, and bond yields fell even further. The yield on the 10-year Japanese government bond, I believe, got down to around 79, 78 basis points, something like that. Again, sounds very familiar. And this was October of 1998, during the worst of the crisis. Russian devaluation, you had all across Asia, all sorts of things going wrong.
LTCM in September was just rescued.
Exactly. So, this was a real deal here, and that's why interest bond yields fell. Now, as Japan was sinking into this lost decade of depression, the central government and the central bank were not sitting on their hands. They had been doing stimulus earlier in the decade, and as the 97, 98 recession showed up in Japan, the central government decided, hey, we're going to go nuts here. We're going to do real massive stimulus because we got to get out of this rut. This is really bad. And so what happened in April of 98 is they unveiled, I believe it was a 17 trillion yen stimulus package that basically kind of didn't really do much because the Asian financial crisis kept getting worse. But in November of 1998, the government one-upped it. And they did what was, at that time, one of the biggest fiscal stimulus packages, if not the largest fiscal stimulus package ever conceived in modern history. It was about 24 trillion yen. And when that was announced, they kept upsizing it in the period before the announcement. So when they finally announced it and they came out with this 24 trillion yen number, it was like shocking. It was this massive thing. And, for a time, people thought, well, geez, maybe this will do it. Maybe this will get Japan out of its rut. We'll get out of this negative environment. We'll get the economy moving again, and it'll end up being inflationary because not only do we have this massive stimulus combined, you're talking about almost 40 trillion yen just in 1998 alone. We also see signs in November of 98 of the economy rebounding on its own, getting past the downturn associated with the Asian financial crisis. So, and then you have the central bank, you have the Bank of Japan with its ultra low interest rate policy, which was a world first at that time too. So it seems like everything was going in favor for it. You have the government finally putting its foot down saying, this will not stand any longer. We're going to do whatever it takes to get us out of this. And so from November, I think it was November 16th or 17th, somewhere around there in 1998, until February 5th, the yield on the 10-year JGB went from around 90 basis points where it had been to upwards of 243, with 2.43%. That was a bond route. And from the context of where they were at ultra low, record low yields in October of 98 to February of 99, where they skyrocketed upward. So that was, hey, the bond market saying, maybe this will work.
And we're saying, well, take a look at what's happening in the United States, where we're just crossing 1%. And we would expect to see much more quickly if it signaled that the economy was really turning around. Jeff, I
Or
don't
even
know.
even if the market thought this was a really plausible scenario, right?
Exactly.
As you're pointing out, right, the Treasury
Yes.
market has gone up, what, about 20 some basis points since November? So 2 months, 20 basis points, where in Japan you had 3 months, 150. I mean, it's not just the size of the move, it's the slope, it's the degree, the angle of ascent. I mean, it was a real rip-roaring bond rout at that time.
You know what my favorite part of the story is that like we often see in the United States, when some big central bank announcement is taking place, the markets sell the news. And do you know what happened? So on February 5th, was it that it reached the height? Is that right?
Yep. February 5th, which was a specific date. And I know exactly what you're going to say.
Well, I have it here as February 12th as being the day that the Bank of Japan announced ZIRP. Am I off by a week or?
No, you're exactly in the right area. And there was, I mean, the whispers of ZIRP have come out before because, central banks don't make announcements. There's always pre-announcements and preparing the battlefield for what happened. But you're right. Early February of 1999, that was when they got to the zero interest rate policy.
Which you would think would have been incredibly stimulative, and it would have added even more rocket fuel to the rocket. It would have been the second stage booster we should have taken off. But I guess this is the story that we're trying to tell people is no.
Right. In the first quarter of 1999, it became very obvious that nothing had changed. You just look at GDP. GDP was significantly negative in the first quarter of 1999, which basically blew the doors off the story that Japan was climbing out of its rut. It was confirmation of the opposite. Nothing. Massive fiscal stimulus, massive central bank, and here's the Bank of Japan coming in saying, "Oh crap, we need to do even more."
No, go ahead.
No, I was gonna say it completely erased every if the JGB market was saying in late 1998 we'll give these guys a chance, by February 1999 it was clear that no, there was no reason to have done that.
And of course, you can hear the echoes of today. Fiscal stimulus is coming in the United States, in Europe, in Japan,
massive,
everywhere.
Huge, unbelievably large.
And the point you made in your article, oh my gosh, I just realized, Jeff, I have never even introduced what it is. They've gone too far, or have they? That is the headline. You posted it at Alhambra Partners on January 6, 2021. And Jeff, in that article, you made the point that the Japanese government, by issuing this insane amount of government debt, did a big favor to the bond market and to lenders, because now they could lend money to the safest entity in a depression. And I wonder if that's what we're going to see when we see a huge splurge in treasuries. It seems to be safer to lend money to this person who's very unlikely to default as opposed to the private economy.
That's what we've seen this year. That's exactly what explains how yields got as low as they were, because you're exactly right. Just like Japan, where issuing government debt was, that's the government, the central government of Japan didn't care about the bond market. They were just doing what their Keynesian economists told them to do. We need to stimulate ourselves out of this economic problem. When the market was saying, as you just pointed out, Emil, we just want safe liquid assets. That's what we're going to do. We're just going to hold on, and there's too much risk in the real economy because it's not moving. And so the Japanese government issued tons of debt, and the Japanese banking system in particular said, I'll buy it. I want it. Outside of these specific periods where maybe we say, well, inflation might be coming, things getting better, and then, oh no, there's no inflation. That's another point. You look at the Japanese CPI, not only did it not turn positive, it was negative throughout this entire time. So this massive fiscal stimulus, this massive monetary policy stimulus, outside of those 3 months in the Japanese government bond market, nothing had changed. In fact, Japan stayed well within its own rut. Nothing, no inflation, no even hint of inflation anywhere.
Jeff, you've often been called the Aesop of the Eurodollar, and you've just told us the story of the frog and that wanted a king. It's classic. But what would be the fable? I think we've gotten to it, but maybe I haven't. Maybe I haven't, right? Like, bigger picture, what is the fable of this article?
It's really about permanent shocks, right? We talked about unit roots before. We've gone over these things. It's really what happens. It's a difference between an L-shaped recovery and a V-shaped recovery. A V-shaped recovery, as you referred to earlier, Milton Friedman's plucking model, some use the neutral interest or natural interest rate theory, whatever it is, it basically says that under normal conditions, when you have a recession, you're going to have a recovery. There's always symmetry involved because a recession is nothing more than a temporary deviation from the trend line. And the trend line doesn't change. The trend line is what the trend line is. It's determined by factors outside of these macroeconomic situations. So if we have a recession, we expect a recovery. And therefore, the government's job in those situations is really to just try to make it as least bad as possible. You know, the point of stimulus isn't to change the trend line in the economy. It's to reduce the pain and suffering that recession brings about. But it's a very different situation where you go into a permanent shock, where the trend line itself has changed, or we can never seem to get back to the trend line from before. What that means is very different circuit. It doesn't matter how much the government spends. It doesn't matter how much central banks do, because they cannot change the situation. It's a permanent shock. And in the circumstances of Japan in the 90s, and even going forward to today, what you see is exactly that. Time and again, what happens is the government grows at the expense of the real economy. In fact, the real economy doesn't grow at all. It's just we keep adding more government spending, and it actually hinders any kind of natural recovery processes, because you're doing things the recovery doesn't need to have done. You know, the old joke in Japan was that all this fiscal stimulus had led to every river being paved over every riverbank being paved over. There's parks everywhere. You know, medium-sized cities have 3 world-class museums. Every single one. You waste all of this government activity or all this economic activity trying to just make a recovery or make a recession that much more comfortable, when in fact it's not a recession. And that's really the fable. It's this idea of we need to pay attention to possible permanent shocks.
That's right. One of the quotes here from the article here is, quote, "In post-money central bank lore, all that's required is shock and awe, a play upon people's expectations." And I urge people to read the article. That whole paragraph there is fantastic. Let me just focus in on post-money. What we need to break out of this situation that we've been in for at least 13 years, Japan 30, is money. We need someone to be creating money. And Jeff, have you heard how so many different countries are implementing this new policy of guaranteed bank credit? So they guarantee the loans that the banks would extend. And it's mixed. Some results are mixed. Like in the United States, there's 2 big programs. The Main Street lending program, not successful. The Paycheck Protection Act or Protection Program, that one was successful. In other countries, it's mixed. It's good, bad. Do you think that there's a possibility that this is kind of a new possibility whereby government guarantees bank lending?
I think that's one of the possibilities of, you know, what they're going to consider, what official sectors around the world are absolutely going to consider, because everything they've done up to this point hasn't worked. And so it's quite natural to start looking for different kinds of answers, but they're all the same kinds of answers. This is not a categorical change in thinking. The categorical change in thinking is not, well, we need to guarantee the bank lending program. It's we need to figure out why banks won't do this on their own. That's what the issue is. It's, you know, I hate to go back and use a Keynesian term, but it's animal spirits. Where are the animal spirits? And the government doing more about giving banks a much safer outlet for what they want to do will only continue to reward that kind of behavior. You know, it's you only want government bonds that are safe and liquid. Then I'm going to issue more government bonds and reward incentivize this behavior toward the risk aversion. We need to stop and think about why are banks and even certain sectors of the non-bank private economy so risk averse, and why are they always so risk averse? And I know we say that and people think, what are you talking about? Stock market's through the moon. You know, there's a corporate credit bubble. Junk bonds are, all this other stuff. There has been nothing more than risk aversion. The banking system has retreated. We show this in all our statistics and all the all the numbers that we have available. The reality is that it's that the banking system, the real economy in particular, has been extremely risk averse, and it does so in ways it doesn't immediately show up on the news or in data or anything else. You think about, especially this year, how small businesses have suffered. So yes, stock prices of the largest corporations are going through the moon because corporations don't have the same problems that the rest of the economy has, and so we have this risk averse situation where nobody stops and thinks, well, why are they being risk averse? And one of the reasons is, and I would argue the key reason is, we don't have a stable financial and monetary system. And stable doesn't mean, oh, the central bank needs to act here or there or do something different. It kind of means that we need no central bank at all. We don't need them to keep making it worse. And that's really what we're talking about is no matter, these kinds of things can go on, these permanent shocks can go on for a very, very long time. And that's really why we keep going back to Japan. And most people, a lot of people say, well, why do you look at Japan? Japan's all about, it's just Japanese factors alone. It has no bearing on what's going on in the US or anywhere else in the world, except that when you take an honest look at the situation over the last dozen years, don't we all look like we're following along in the Japanese model? It really, it's not, Japan isn't an isolated case. It was just the first case.
Jeff, am I correct in that you don't have an economics doctorate, and that if you were offered an honorary economics doctorate, you wouldn't accept it?
Yeah, that's probably true. Never really thought about it, but now that you mention it, I probably wouldn't want it.
Well, I set you up. It's a trap, Jeff, because
okay.
Who does have an economics doctorate? Copper. And in part 2 of episode 41, we're going to talk about Copper, who might be disagreeing with you.